Okay, today we are talking about a topic that has been making waves over the investment and finance world. The VF Corporation dividend cut. Yes, that's it. You heard me correctly. After 50 years of dividend raises, they are going to cut their dividend. Now, as a result, many investors are going to be left wondering if this once promising stock is still worth considering as an investment. So, in this video, we're going to look at what happened, why you might still be interested, and then stay tuned until the end of the video because I will tell you what you need to monitor and what you need to watch for very closely to ensure that you're not going to lose money if you want to invest in VF Corporation going forward. So look, this is a multinational apparel and footwear company. It's got a lot of well-known brands like the North Face, Vans and Timberland under their umbrella. Now recently they've just announced this big dividend cut of 40%. Now for many dividend focused investors that's going to be a really big deal if you're counting on that income stream. So it's absolutely understandable if you're feeling a little bit uneasy about the stock's future. So we're going to look at why this is still possibly a good investment and why it's still a strong company. But I want to also in this video take a step back and we're going to look at what prompted them to make this pretty big and ballsy move. We're going to look at what they've been doing, what they're investing in, and what those plans are moving forward, how they've been transforming themselves. Now, cutting the dividend is one way to free up their resources to actually transform this company and remain viable and continue to grow. So, why might investors still be interested in VF Corporation? They've still got an incredibly strong portfolio of world-class brands. They're still investing and they still plan to be growing. They've got plans for some strong earnings growth. And even after the dividend cut, the dividend yield still remains higher than the S&P 500 average. So there's a lot of good things to stick around for. And please wait till the end of the video. Learn about what you do need to monitor very closely and carefully before you invest in VF Corp. Alright. And so here we have it, the VF Corporation Q3 2023 earnings call transcript. Now, amongst all the other news, this was big. One of the big challenges that they've had has been their financial position. After the pandemic, they were deeply, deeply hurt. They took on quite a bit of debt. Now, one of the big things that they're trying to do is they're trying to get the ship right again. They are shifting resource priorities across the company. They're focusing on the biggest consumer opportunities within their existing brand portfolio and they're looking for enhanced operational performance. Now, a big part of this plan is going to be right-sizing the dividends. Now, what does that mean? It means after 50 years of increasing the dividends, that is coming to an end for VF Corporation. Right-sizing, they're not eliminating, they're just bringing it down and scaling it back. Now if we just scroll up just a fraction here, we can see that the declaration was that they're reducing it by 40%. So that's quite a big cut. In addition, they're going to explore sale of non-core assets as well as cutting costs. Now what does this mean? So they're reducing the dividend by about 40%. They do believe that a good strong dividend is part of their total shareholder value creation, but they need to reduce that dividend so that they can actually get the debt to EBITDA ratios back on track and then begin to rebuild the dividend and begin increasing it again based on what they believe will be very solid cash flows in the future. So dividends are still an important capital allocation priority, but it is being decreased, and that's something that many investors do need to think about carefully. Now, one of the questions on the call was the dividends. How do we know there isn't a further dividend cut coming, given that this was, absolutely crucial and a key part of the VF Corporation story? They say they're going to continue offering strong dividends. It wasn't a step they took lightly, and the big thing that they're trying to do is they're trying to keep the capital allocated in a way that they'll be able to pay down debt and continue to pay dividends. Now, by decreasing at this amount, it's going to focus on a payout ratio of about 50%. So at the moment, they've got quite an elevated payout ratio, which is quite concerning. And by doing this, they'll still be able to invest, they'll still be able to make acquisitions, they'll be focusing on reducing their inventory, they note, working closely with suppliers, getting the right stock in the right place at the right time. So they've got a lot of big plans, and they're going to need capital to make those plans happen. The dividend cut, in this case, it becomes a necessary mechanism for them to ensure that they have the financial stability to right this ship and get things back on track. Now, just turning back to fast graph. So what does all this mean? Well, in practice, if we look back here historically, the white line represents the dividends, the orange line here represents a 15 times price to free cash flow ratio, essentially. And a lot of the time this has more than covered the dividends. The big differences being in this patch here, 2018, and then around the pandemic and now after the pandemic. Now there's different ways of looking at this. They mentioned on the call a comparison with EBITDA, looking at a 50% payout ratio, and we can see here in the past a dividend payout ratio in terms of EBITDA was about 20%, 23%, 13%, 22%. It became elevated in 2018 at 55%, 40%, 53%, 32%, and they're going to be trying to get that ratio down to a healthy and manageable level again. In a very simple sense as well, you can begin to look at it in terms of the adjusted operating earnings, and again you can see that distance, so that gap between the dividend payout and the orange line there representing earnings, it's been decreasing substantially, and basically other than 2021, here in 2023 financial year for them, it's basically bang on. So a very, very elevated payout ratio here, which is not a comfortable position for the company to be in. Now, if they maintain the dividend and the earnings increased, they'd still be looking at a dividend payout ratio here based on their earnings of 87% in the 2024 financial year, which is still very high. So that's the situation. That's what's going on. Big dividend cut for the first time in 50 years. What does this mean? Is VF Corporation a good company, and is there still a good reason to invest? Let's turn and look at that next. VF Corp has been a very successful company. So looking at pre-pandemic, they have traded below 15 times PE for many years, and then from about 2011 the stock price really began to take off, and trading very, very high at about 29, almost 30 times PE in 2018. Now, of course, we know what happened then. The pandemic hit, and VF Corp hasn't really recovered, and in fact even after the pandemic the share price shot up again, and then it has decreased quite cataclysmically. So I think the big reasons for the decline in share price here has been a number of disappointing news items for investors. Inflation, increased inventory levels, some tax issues, but perhaps most importantly has been the slowdown of Vans' sales. All of this has really damaged the share price, and we can see the weak earnings through the pandemic. Even though there was a bounce after the pandemic, the 2023 year looks as though it's going to have very weak earnings as well. Now, switching over to fast graphs on the financials, looking at their overall fiscal fitness, we can see traditionally the green bar here showing free cash flow has been substantially higher than the dividends per share in purple, and we can see that all through most of the last 20 years up until the 2018 year, and we can sort of see some challenges here as well. 2020 with a lower free cash flow to dividends, and again here in the 2022 year. So that doesn't look particularly healthy. Now, the management has been very good at buying back shares at an accretive rate for the shareholders. Sales revenue had been increasing for most of 2001 through to 2015. It's had a few rough patches in the last 5 or 6 years though. Net income has been sort of on a bit of a decline in the last 5 years as well. their margins have been holding fairly steady, but as we see here in black, the sub-industry norms, their margins are actually lower than the norms for their sub-industry, which is a little bit worrying and concerning. But if we look at the return on invested capital, that's been fairly constant as well, which is what I like to see as an investor. Now, just switching over to again look at the margins. So we can see in a very simple sense here, the blue bar here is below this average line, so sort of indicating that they've had their gross margins been below the sub-industry average, as has their operating margins and the net margins basically for most of the last 20 years. So it is a good company. They have 3 brands which are accounting for roughly 80% of the sales. And I think the strength of these margins and the consistency of their margins indicates that there is a reasonably narrow moat and economic moat there for VF Corporation, but it does exist. So switching back to fast graphs, we can see in the 2023 year there looks to be a decrease in estimated sales of about 2%, but this is followed by around a 5% increase in sales to 2024, and then a 7% increase in sales to 2025. So it does look as though they have an expectation of increased sales. This is probably going to be driven by their Vans brand, which appears to still be doing fairly well. Now, this was a brand that they picked up about 20 years ago. At the time, it had very little growth behind the brand. It wasn't a very successful brand, but the management at VF Corporation had managed to turn this brand around and really propelled it into a higher growth and a very high value brand. And it's this sort of management capability which generates an intangible asset in these brands, and that's what drives VF Corp's narrow moats. Now, if we switch over to the operating or adjusted earnings, we can see actually in the 2024 and 2025 years, we're actually expecting double digits here based on analyst expectations, double-digit increases of about 13% each of those years. So in terms of there's that increase in sales that we just talked about, but there's also a lot of work going on behind the scenes where they'll be reducing their inventory levels, freeing up cash flow there, and that's really going to propel a lot of these earnings as well. Now, the company itself does have a BBB plus S&P credit rating. And they've got a nice strong balance sheet. Now that's going to give them the opportunity to go out and make acquisitions, and traditionally that's where VF Corp has been very strong. It's been in driving those acquisitions and turning those around to create value for the shareholders. They've returned dividends as well for 50 years. That is changing, as well as share buybacks that we've seen as well with the decrease in the outstanding share count. Now, the big question is, can VF Corp capture that long-term growth in earnings, long-term growth in sales that we've seen? We're showing here the adjusted operating earnings on fast graphs. And the big question is, can they continue to do that in the future? Now, they've got strong brands, they've got an exceptional management team, they've still got a strong balance sheet, and I think they're taking the right moves to shore up that balance sheet and to provide them with some stability moving forwards. They incurred a lot of debt during the downturn around the pandemic. They took on quite a lot of debt that has put a bit of a dent in their financial stability, but by cutting the dividend back, working through the inventory problems, and then working to pay down that debt, I think they'll be in a very safe position moving forward. Based on these increases in earnings, based on the reduced dividend, I think it will be probably at about 5%. Or 4.5%, I think they'll be able to still return high single digits, maybe very low double digit returns to shareholders looking to invest. Certainly not going to be a long-term huge dividend grower. It could be the case that they hold the dividend steady for several years again while they pay down that debt. And it's really sad to see another company lose dividend king status like this. So, if you want to invest in VF Corp today, what do you need to be wary and careful about? Number one, keep a very close eye on those inventory levels. Now that things are beginning to normalise, those inventory levels must come down. If they do not, that should be a big red flag for you. Number two, debt levels. look to see whether or not those debt levels are coming down. Again, if the debt levels do not come down, that is a sure sign of very big problems coming up for shareholders. Number 3, sales. Do they retain a strong economic moat? Well, as I've already said, I consider them to have a small, narrow economic moat from the strength of those brands, but they still seem to be very reliant on traditional shop, brick and mortar sales. So keep an eye on those sales through that channel. Again, if those begin to drop off, that would be concerning and quite alarming for these brands. So keep a very close eye on those elements. If you can monitor those and it all looks good, it could be a worthwhile long-term total return investment. But again, always look to buy this at the right price.